Okay, so economics, very easy topic, right? Uh, Fortunately, now if you see economics, you have 8 readings which are not so lengthy, and the weightage is enough. You have around 11 to 16 questions that you can expect in exam. At least you can expect 13, 14 questions, which is a very sizable thing compared to what it was before. Before, economics was so dreaded. It was so intense, so detailed. Now they have, compressed it. Now, even though economics is not going to take too much of time when you revise it, but the problem is that scoring in economics is a bit tricky. Okay, so what I've noticed from students is that they find economics very easy to read, but very difficult to score. High performance scoring is difficult. Okay, so here I have made sure that most of the questions are CFA Institute related questions because they are a bit trickier. So I've put almost all of those important varieties. Okay. So we'll begin with that. Again, you have 8 readings. The last 4 readings are very easy, including the last 2 readings related to currency. First is the reading where you have the firm and the market structure. Unfortunately, economics starts right in the middle. Instead of explaining demand supply, they directly start midway about the market structure, which is not appropriate. In the past, they used to have all this thing. So that's the problem with economics. Okay. But still, ignoring all of that prerequisite thing, you can pretty much manage economics very well, right? Let's start with the first topic, which is related to the firm and market structure. So here are the questions. The first topic discussed about the 4 types of market structure: perfect competition, monopolistic, oligopoly, and monopoly, right? Before that, under the perfect market structure, we had something called that it's a shutdown point. Remember shutdown point, correct? Where the price is compared with the average variable cost and average total cost, right? That gives you the break-even point. Okay, so most of the questions are going to be related to that. The shutdown point is very important. Let's start with that. The short-term shutdown point of production for a firm operating under perfect competition will most likely occur. See, understand one thing, that if your price is below the variable cost, if you can't even recover the variable cost, there's no point of continuing the business either in the short or even in the long run. Correct? If the price is above the variable cost, you will wait and watch and see, continue the business for short run, not in the long run. Why? Because your break even is at ATC, average total cost. So here, the short-term shutdown point of production will most likely occur when price is equal to ATC. No, this is the long-run shutdown point. Marginal revenue equals to marginal cost, or marginal revenue equals to average variable cost. Can you answer, everyone? What is that point? The short-term shutdown point is where? It's where exactly? ABC? Yes, it's at average variable cost. Remember, your short-term shutdown point means if the revenue is below this point, that means there's no point of continuing the business. Always remember that average variable cost, AVC, plus average fixed cost is equal to average total cost. In the short run, you should at least cover your variable cost. In the long run, you should cover both. This is your short run shutdown point. This is your long run shutdown point. Got it? Under conditions of perfect competition, a company will break even. Break even. As I said, break even is where marginal revenue is equal to which point? Everyone in the class. Marginal revenue is equal to, I told you, what is that you need to cover? Break even point is again at average total cost. Why? Because at this point you cover your opportunity cost also. Remember, in economics, you're looking at economic profit, not accounting profit. Economic profit also includes opportunity cost, right? So your, see, they are not telling you, they are not asking you short run shutdown point. They are asking you, where do you break even? You break even when your revenues or when your price is at ATC. That's your break even point, because that's what you, where you cover even the opportunity cost. Price above ATC, if your price is above ATC, that's where you make economic profits. So your economic profits are zero or at break even when your price is at ATC. Below ATC, average variable cost, You are actually not making economic profits, but you will continue in the short run. Understood by C? Correct? By A, ATC, right? Next, see this. A company will shut down the production in the short run. In the short run, if the total revenue is less than, very easy, total revenue is less than variable cost. If you can't even recover your variable cost, there's no point of continuing the business. Okay, see this. A company has total variable cost of 4 million, total fixed cost of 3 million. So what is your total cost? It's fixed and variable, both together is 7 million. Based on this information, company will stay in the market in the long run. Guys, in the long run, you should cover only variable or both. In the long run, you should cover both, right? So my answer will be 7 million. But if they had used the word short term, if they had used instead of long term, the short term, then I should at least cover 4 million. Understood, everyone? Clear? Okay. When total revenue is greater than total variable cost, but less than total cost. So you should continue in the short run, but shut down in the long run. In the short term, a firm will most likely exit the market, stay the market, or shut down. What will you do? In the short run. In the short run, in the short run, yes, 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 yes. Total revenue is greater than total variable cost. So you will continue, yes or no, everyone? Hello, everyone? You will continue staying in the market in the short run, isn't it? Yes, in the short run, you will stay in the market. In the long run, you will shut down. In the short run, you will stay in the market. But if it is below total variable cost, you will shut down. Got it, everyone? Right? Clear? Under perfect competition, in the long run, the firm will most likely earn. See, perfect competition is like your local retail outlet, the Kirana or Bakala, whatever you call. That's a perfect competition, right? Bread, that's a perfect competition. Now, in this case, in the long run, will the firm earn normal profit, positive economic profit, negative economic profit? Very, very interesting. I love this type of questions. Yes. See, first of all, positive economic profit means your price is above ATC. In perfect competition, price above ATC is not possible because since there are no barriers to entry, others will jump in. So you will always be at break even. This is where your economic profit won't be either positive, won't be negative. You will be earning only the normal profits. Understood? Got it? Now comes very interesting thing, economies of scale. Do you understand economies of scale? If you have seen my videos in that I explain economies of scale is what, which country has experienced massive economies of scale. What is economies of scale? The more you produce, the cost per unit goes down. Yes, very good. I'm very happy you all have watched my lectures. China, economies of scale. In the long run, why Chinese products are cheaper? Not only because the labor is cheap. Do you think labor is cheap? No. Chinese labor is not cheap. It's just economies of scale. The more you produce, the cost per unit goes down. Got it? So a firm increases its quantity produced without any change in per unit cost. Very interesting. Is it economies, diseconomies, or constant? Everyone check, check, check. ABC. Economies, diseconomies, or constant? Guys, as you produce more, the cost per unit, if it is decreasing, it's economies of scale. If it is not neither increasing nor decreasing, it is constant. But if it is increasing, it is diseconomies. So diseconomies when the cost goes up, economies when the cost goes down, constant when it neither goes up nor goes down. Understood, everyone? Correct. Yes. Okay, great. A company is experiencing economies of scale, means cost per unit will go down, right? So when will this happen? When its cost per unit as output increases? No. Its operating point on the long run ATC curve at which slope is negative. Slope is negative means if you see graphically, the long run ATC curve, the graph goes down where I will show you in my world famous beautiful notes. See, this is what it is. See, such a nice way to promote your books, right? See this, it's going down, means cost per unit is going down. This is the point where we say minimum efficient scale. This portion is called economies of scale, where the slope is negative because it's going down. This is diseconomies of scale, and this is where it is constant. Understood? Clear? So economies of scale is where cost of production per unit is going down. That's a negative slope. Graphical, if you see, it's a negative slope. So it's operating at a point on long run average cost curve at which the slope is negative, means it's going down. Clear, everyone? Why B is the answer? Everyone got it? Okay, so next one, I'm sure everyone will answer looking at the graph. Diseconomies of scale, most likely, first of all, when diseconomies is when the slope is negative or positive. Diseconomies is when the slope is positive. This is where what happens, guys? The company's cost of production per unit is going up. What does it tell you? That you should not increase your production. Why is that the case? Because maybe the companies or countries have become too much bureaucratic problem. It have become so large companies face these issues, the government companies, there is lack of decision making, department to department approval, and so on. So diseconomies occurs. Specialization, no, that results in economies of scale. Overlap of business function and product lines, yes, isn't it? So many approvals, so many department, that is lagging the work. That's the best example of diseconomies of scales are government institutes. Uh, I'm talking about our country, okay? In India, and many other countries where department to department, the approval takes a lot of time compared to private companies, which are super fast. Understood, everyone? Guys, you all are not answering ABC, ABC. I need you all to take risk. Have risk appetite. Take risk, even if it is wrong, no problem. A firm is operating beyond minimum efficient scale. Means, see, first of all, should you operate beyond this minimum efficient scale? If you're operating beyond that, that's not a right sign, right? That's diseconomies of scale. Correct? So, in a perfectly competitive industry, to maintain long-term viability, the most likely course of action for the firm is to see, guys, if the firm is operating beyond the minimum efficient scale, means it's producing much higher, that the cost per unit is actually going up, diseconomies of scale. So they are saying to maintain long-term viability. Can a firm make long-term economic losses? Can a firm survive with diseconomies of scale? No, it cannot. So should it operate at the current level of production? No, it should not. Why? Because it is diseconomies. Increase the level of production? No, again, that's going to backfire. You should stop. You should decrease the level of production. Why? To the minimum point. Why? Because that's where the cost is not increasing. See, all these questions, if you look at graph, they will make more sense. So if someone is producing at this point, this is where their cost per unit is going up. So they should rather scale it back. Rather scale it back. Understood? Means they should produce less and reduce their cost per unit. Clear? Okay. This was basically from the first topic where you were mostly asked about firm and market structure, right? Then we go to the second topic, which is very important, that is business cycle. If you are aware, business cycle. Okay. Now, in business cycle, if you see in business cycle, most of the discussion is related to in business cycle, most of the discussion is related to the indicators. There are three types of indicators, if you are aware: leading, lagging, and coincident indicators. Leading, lagging, and coincident. So many students get confused because of these types of indicators. Okay, leading, lagging, and coincident. Now, leading indicators are those which gives you signal about they give you signal beforehand. Lagging, they give you the signals late after the things have happened. And coincident is roughly at the same time. Okay. Let's see that. As the expansion phase of business cycle advances from early stage to late stage, see, there are four phases of business cycle: expansion, first expansion, then peak, then contraction, and then the bottom is called trough. Okay. So expansion, peak, then contraction, fall, and then finally at the extreme bottom. Okay. So they're saying as the expansion phase of the business cycle advances from early to late stage of expansion is where the economy is going to peak. Okay. The business most likely experience a decrease in labor cost, capital investment, or availability of qualified workers. Everyone, when economy is expanding, economy, they are saying what is happening? Economy's expansion is increasing. Okay, it's a well-established expansion. Correct. Now, during this time, companies are doing more investments. The cost of the labor is also increasing. What is the problem at this point? Tell me. Yes, A, B, C. Guess it. B, capital investment is decreasing. Capital investment actually decreases later. When the economy reaches the peak, that's the sign that economy is peaked. When the peak arrives, that's where you will see capex falling. Okay. So the answer here is, everyone guess, the answer is availability of qualified workers. Why? Because see, when the economy is experiencing very high scale of growth, what happens is that it's difficult to find qualified workers. Business have difficulty in finding the workers. That's what was the issue with Canada when it was expanding at a massive scale recently. What happened? They were finding it difficult to hire people, Canada and Germany. That's where they opened up immigration. Correct. Of course, now it is going opposite because the inflation has risen very high. The indicator index is created by various organization or research agencies. See, many indicators are created by the government, many are created by independent agencies, some are created by private. Okay. They are saying those created by various organization or research agencies include only leading, are highly reliable signals on the phase of business cycle, evolve over time in terms of composition and computation formula. Guys, any hypothetical statement is incorrect generally. Include only leading, no. The market indicators, they include leading, lagging, coincident, all. Are highly reliable signals. Guys, none of the indicators are completely reliable. You cannot say any indicators are reliable. Um, all the indicators you have to look in combination. Correct. So the one thing is certain, they might not be 100% reliable, but since these are done by research agencies, they evolve over time in terms of composition and formula. They are not constant. These indicators get updated. Update is a very important quality of indicators. Many indicators given by the government, they are not updated. The problem with government indicators is that many of them are not updated. Right. Understood. So the answer here is C. Why C? Because these indicators are generally, all these public indicators are regularly updated to, because things might change. Let's say the inflation basket. Inflation basket is not the same. 10 years, 20 years back, in the inflation, there were desktop computers. These times you have iPads or smartphones. So the baskets have changed. So the indicators don't remain the same forever. The composition doesn't remain the same forever. Got it? Which of the following statement is best description of the characteristics of economic indicators? I told you three types of indicators: leading, lagging, and coincident. Leading indicators are important because they track the entire economy. No, to track the entire economy, you require all three. So this is slightly hyperbole statement. Lagging indicators in measuring past condition do not require revisions. No, one of the biggest drawbacks of lagging indicators is that they are restated. Many times the government also restates these indicators. Okay. So, of course, the third one, a combination of leading coincident indicators can offer effective forecast. Yes. Whenever you combine more than one type of indicators, that will be much more effective. Understood? So no single indicator is a foolproof answer for everything. Clear? See, there you need to be very logical also. A and B are very, very, I should say, very not so inclusive statements. So C is more inclusive. Got it? Anytime when you see some of the statements are very exclusive, only this, only that, these type of words, they are incorrect. When the spread between 10-year treasury yields and the short-term federal funds rate narrows. See, first of all, when the spreads narrow, okay, spreads narrow. What is that indicator? Spreads. Spreads narrow means the interest rates are going to increase or decrease? Interest rates are going to decrease. See, uh, answer D. Yeah, decrease. Oh, got it. So interest rates are going to decrease, right? Okay. Interest rates are decreasing. Is that a good sign or a bad sign? See, hear it out carefully. When interest rates are decreasing, by the way, interest rates are leading indicators or lagging indicators, everyone in the class? Interest rates in the market, they are the prime rate, especially, right? The prime rate is a lagging indicator. No, interest rates, bond yields are leading indicator. Interest rates by the bank is a lagging indicator. Very interesting thing, okay? See, the bond yields are leading indicator. S&P 500 or index is a leading indicator. But interest rates decided by the bank, like the prime rates, they are lagging indicator. Okay, very minor difference in this. Now, coming to the point, see, the spreads are narrowing, means the general interest rates are going down. Okay. Now, how do you relate this? When interest rates are going down, the demand for money is increasing or decreasing? The demand for money is actually decreasing, isn't it? Because if the demand for money is increasing, the rates will rise. The cost of borrowing will increase. So, what type of indicator is that? And see, again, there is more information. When the spreads narrow and at the same time, prime rate stays unchanged. Prime rate is a lagging indicator, right? Now, see, prime rate will be reflected later. It's a lagging indicator. The mix of indicators most likely forecast economic growth, decline, or stability. Everyone, very interesting. Nice. I've got some answers. Very good. What about others? Yes, 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 yes. Everyone. Very good. It's a decline. See, growth is what is the sign of growth? Growth is when the interest rates are rising because the demand for money is increasing. Stability. See, prime rate is a lagging indicator. As I said, see, prime rate is a lagging indicator. Let me write down here. This is a lagging indicator. Therefore, what happens? The rate is stable. Okay, but it's a lagging indicator. It will be falling later. That's why I did not choose stability. Okay, because it's a lagging indicator. Clear? Very nice. If relative to the prior values of the respective indicators, inventory to sales ratio, very interesting. Inventory over sales. First of all, tell me, is it a leading or a lagging indicator? Inventory to sales, inventory to sales. Just for your information, inventory to sales. If you notice here, do you find somewhere inventory to sales? It's a lagging indicator. Understood? Everyone? Yes, very good. Nice. So it's a lagging indicator. Unit labor cost is stable and real personal income has decreased. Guys, what is real personal income? What type of indicator it is? Can someone tell me real personal income? What type of indicator it is? That's a coincident indicators. Coincident. Yes, see, check out in the notes here. Real personal income is a coincident at the same time of business cycle. Okay. Now, it is most likely that a peak in the business cycle has occurred, is about to occur, or will occur in some time. Now, first of all, they are saying inventory to sales ratio has risen. Has risen means the either the inventories are too high or the sales have been falling. Isn't it? Correct? Those who are aware about the technique through which I analyze the ratios, either the numerator is increasing or denominator is decreasing. That can be the reason that the inventory to sales ratio has risen. That means you are unable to sell enough or your inventory is being accumulated. Correct? This, since it's a lagging indicator, means something has already happened. Now you are seeing it. Means your inventory have been accumulating from the past. Your sales have been dropping from the past. That means the peak, see, after the peak, there is a contraction. So the peak has arrived, about to occur, or will occur. Very interesting. Tell me. Yes. It has occurred. Why occurred? Because it has already occurred. You are seeing that now. Your indicator is lagged. So you are seeing something which has already happened. So your peak has already reached. Now you are seeing the indicator. That's what the problem with lagging indicator is. Are you getting my point? Lagging indicator shows you the result later. So the economy is already peaked. Now you are seeing the indicator. Are you getting my point? Understood? I told you at the beginning of the session. The problem with economics is that economics is very brief, not so complicated when you read. But when it comes to answering the questions, the choices are so tricky. Understood? So my experience is that students find it difficult to score. Okay. Yes. When aggregate real personal income, which is a coincident indicator we just saw, industrial output and S&P 500. See, S&P 500 is a leading indicator, but industrial output, see, industrial output, index of industrial production, that's a coincident indicator. But see, that is index of industrial production. Okay. Now, apart from that, industrial loans, ratio of consumer installment, these are lagging indicators. So see here, all are increasing, all increase in a given period. See, all the types of indicators are increasing. The leading, lagging, coincident, all of them are increasing. Okay. Now, all the types of indicators are increasing. It is most like accurate to conclude that a cyclical upturn is 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 occurring, about to end, or about to begin. See, whenever all the indicators are changing, that means something is going to happen. Understood? There is something going to happen. When all the indicators, remember, when all the types of indicators, when all of them change, that means something is about to begin. A new journey is altogether begin. Of course, some people can say something is about to end. But the reality is that when coincident, first the markets react. Then you will see those reflection happening in the other indicators also. But when all of the indicators are moving up together, that means there is a change in the cycle. So what is going to happen? It is most likely to conclude that the cyclical upturn is about to begin. About to begin. I'll repeat, it sounds very tricky, but that's an accurate answer. Understood? Increase in all the indicators together, that means whether leading, lagging, or coincident, when all of this is happening together, that means it's a beginning of a new cycle. You're probably entering into a new cycle. Understood? Correct? Occurring, it's not occurring. It is about to change. Whenever there is going to be a change, all of the indicators start flashing together. Okay. Which of the following is most likely to increase after an increase in aggregate real personal income? Again, coincident indicator. So, coincident means almost at the same time. Correct? They are asking which of the following is most likely to increase. See, when the coincident indicator is increasing, increase in personal income means people's income is increasing. That's a good sign, right? That's a healthy sign of economy. So, which of the following is most likely to increase? Equity prices, Guys, equity prices are leading indicators. So they have already increased. In fact, equity price don't wait for the indicator. Markets have already reflected that. Markets react the first. So not equity prices. Building permits, building permits are also leading indicators. Understood? So the ratio of consumer installment to the debt income, yes. Consumers installment debt to income means, see, whenever what happens, whenever the real personal income increases, people are willing to take more debt. They are willing to borrow more for houses and all. It's very simple. See, if you overthink, it will become complicated. As soon as your boss is going to announce increasing of your salary, you start thinking, oh, how much EMI can I afford? Let me borrow more to buy a house. So as the income is increased, immediately you see what people's debt relative to their income increases. Understood? Which of the following indicator is most appropriate in predicting a turning point in the economy? Turning point in the economy. The index, the industrial production index, average bank prime lending rate, average weekly hours manufacturing. Now, first of all, you have to tell me before you answer, tell me what are these three indicators? Coincident, leading, lagging. Which one? Industrial production index. Industrial production index, everyone. Coincident, leading, lagging. Industrial production index, C, index of industrial production. It's a coincident indicator. Correct? Average bank prime lending rate. I told you bank prime lending rate is a lagging indicator. And weekly hours manufacturing, non-farm payroll. These are, these are leading indicators. See, if you see here, average, where is it? Leading indicators, non-farm payroll, where is it? Do I see this? Building permits, I see consumer expectations, on-farm payroll. No, I haven't in my indicators. So average weekly hours manufacturing, this is like a leading indicator. Okay. Now, what is the situation here? What is the question here? The question here basically is asking us that, let me first write down this leading indicator. Okay, the question is which of the following is most appropriate in predicting a turning point? Who is going to give you the information beforehand? That is the leading indicator. The only leading indicator here is average weekly hours. Okay, all others are not leading. So leading indicators, the good thing about leading indicators are they give the information before the other indicators, right? So the average weekly hours is a leading indicator and they will give us me the information, something which is going to happen. Beforehand, they give me the information. So leading indicator always are the ones who give you what is going to turn around. Okay. The unemployment rate, which is from the past, is considered a lagging indicator. Why? Because of one very interesting thing. Do you think companies fire or hire immediately? No, they take time. They take time to hire and fire. They only fire people if they think there is persistent fall in the economy, right? So what is the answer? New jobs must be defined to count their workers. New job types must be defined. Multi-worker households change jobs at a slower pace. Is that the reason? Or businesses are slow to hire and fire? Isn't it? Everyone, C is the correct answer. Businesses take time to hire and fire. Only if they see a potential increase in business, then they hire. Okay. During an economic recovery, recovery is when you're going from the bottom to, from the trough. So if you see here, from the trough, you are going to expansion. So from last point to the first point. During economic recovery, a lagging unemployment rate is most likely attributable to, why is the unemployment rate, they are saying a lagging unemployment rate. First of all, what happens? Unemployment rate, as I said, employment rate or unemployment rate, what it's a lagging indicator. Businesses are slow to hire and fire. So you will see its effect later. is most likely attributable to business quickly rehiring workers. Do they quickly do that? No. New job seekers enter the labor force, underemployed workers transitioning to higher paying jobs. That happens at the peak of the business cycle. That doesn't happen in the greatest time, right? So, during economic recovery, a lagging unemployment rate is most likely attributable to everyone. A, B, C. The answer, yes, 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 is B. B is the answer. New job seekers enter the labor force. And because they enter the labor force, what happens? These new job seekers, because now the economy is opening up or economy is recovering, right? In this case, if the new when the new job seekers enter the market, they enter the labor force, what happens? Do they immediately get work? No, it takes time for them to get work, right? Because the market is still recovering from the heat. So due to this, it will take time for them to get work. Therefore, the even if the economy is recovering, unemployment rate might be still high because new joinees or new people who are entering into the labor force, they might not suddenly get hired. Understood? So the unemployment rate might still be rising because see, every year, let's say in India, every year millions of people finish their universities, right? They are waiting for the jobs, correct? But what if the economy is not growing or economy is just recovering? No one will be willing to hire them immediately. You've seen many IT companies delay their recruitment. Why is that so? Because they are not sure about the economy. So the unemployment rate, see, I'll tell you one very interesting thing. So if the businesses are not keen to hire, the unemployment rate is always going to keep on rising in an economy like India, because every year millions of people come out in the market for jobs. Understood? So first of all, government is inefficient globally to provide jobs. Government is inefficient. Okay. So relying on the government for job is a stupid idea. Now the private will only invest, and even if they invest, they will wait and watch for the economy to sustain. Only then they will hire. So if their hirings don't increase with the rate of the people getting educated, then there will be massive unemployment. Understood? My personal belief, I don't want to drift away from the topic, is that unemployment increasing is also because, see, amidst all the negative thing, of course, government is to be blamed. This has to be blamed. You can blame everyone, but unemployment increasing is also because the amount of people coming out in the sector eligible for the work is increasing massively. Understood? So more and more people getting educated, skilled, that is always going to increase the unemployment. Understood? Correct. But talking about it, it's like a political storm. So no one is willing to talk about it logically. Clear? Crowding out refers to what? What is crowding out? Now, guys, we are moving to monetary and fiscal. Okay. First of all, crowding out is when the government borrows so much that very little amount is left for the private sector. So the cost of borrowing goes up. Got it? So crowding out refers to a fall in interest rate. No, it increases the rate. Rise in private investment. No. Rise in government borrowing, that reduces money left for the private sector. Understood? 21C. Clear? Clear? Contractionary fiscal policy. Guys, fiscal policy is expansionary when that, see, fiscal policy is about taxes and government spending. So when government spending is high or when taxes are low, it's expansionary. Contractionary is when the government spending is low or taxes are high or both. So contractionary fiscal policy will always involve which of the following? Balanced budget, reduction in government spending, yes or no, everyone? When government spending goes down, government spending goes down. Yes, is it contractionary or fiscal? Sorry, contractionary or expansionary? Reduction in government spending. Contractionary fiscal policy will always involve reduction in government spending. Fall in the budget deficit or rise in the surplus? See, very interesting thing. First of all, budget deficit and surplus. What is budget deficit? Budget deficit is when the spending, I will write S, when the spending is greater than the tax. And budget surplus is when the spending is less than the tax. Okay, now see, very, very interesting thing. Fall in budget deficit means when will the deficit go down? When the spending is going to be less, isn't it? If the spending is less, the deficit will go down. Or rise in surplus. Rise in surplus. Surplus will increase when the tax increases. Now, if you notice, there's nothing wrong with B, but B is incomplete. Most of you all have answered B. B is incomplete. They are saying reduction in government spending. I agree. But what if reduction in spending is balanced by reduction in spending? Government is spending less. But what if along with that, government also reduces tax by a higher rate? So spending, let's say it's reduced by $50 billion, but taxes are reduced by $70 billion. Then it's a taxes are reduced more. Then it's not a deficit. Understood? So B is incomplete statement. You should not only look at spending or only look at tax. You should look both. And that is deficit and surplus. Budget deficit and budget surplus considers both. So yes, B is not wrong answer, but it's incomplete. We don't know whether the taxes reduce simultaneously along with B, government spending or not. So B, again, B might not be wrong, but C is more appropriate because C takes care about the spending and taxes both. Understood, everyone? Why not B and why C is the answer? Clear? See, the objective of doing this session with you all is to just clarify these micro points. Got it? Which of the following statements are most accurate? Ricardian equivalence refers to individuals having no idea of future tax liabilities. See, Ricardian equivalence is where it's the opposite. Actually, people know that right now the government is reducing taxes. That means in the future they are going to increase the taxes. So it's not that they have no idea. They rather have the idea. So A is wrong. Governments do not allow political pressures to influence fiscal policies. Absolutely wrong. Government succumbs to political pressure. That's why you see in countries like India, Pakistan, and the Asian part, where what is the South Pacific part, what happens? South Asian countries. What is the issue there? The government succumbs to the public pressure because of politics, and they start reducing the taxes just before the election. So it's not that they don't allow; they definitely succumb to that. If there is high unemployment in an economy, then easy monetary and fiscal policy should lead to an expansion in the aggregate demand. Yes, this is the solution that most of the time happens. When there is high unemployment, you start giving freebies, you make the fiscal policy expansion, and you start spending more, you keep the interest rates low. Those are the stupid things that most of the times governments do because they have no other ways of reducing the unemployment. Understood, everyone? Why C is the answer? Which statement regarding fiscal policy is most accurate? Cyclically adjusted budget deficits are appropriate? Yes or no? Correct. See, budget deficits change according to the business cycle. So there is something called cyclically adjusted budget deficit. They are correct indicators of the fiscal policy, right? They basically take care about the cyclicality because at different point of the business cycle, the deficit keeps on changing, right? So what is cyclically adjusted budget deficit? It is the type of budget deficit where the economy is at full employment. Understood? So the correct answer is A. I'll just read B and C. Why? To raise business Capital spending, personal income taxes should be reduced. Capital spending, personal taxes should be reduced. No. Increase in budget surplus is associated with expansionary. No. Increase in deficit is associated with expansion. Clear? The least likely explanation for why fiscal policy cannot stabilize aggregate demand completely means which one is not supportive. Okay, least likely. My problem is with these least likely. Least likely means in your head, you should think that you're looking for a wrong answer. So what is the statement? Why fiscal policy cannot stabilize the aggregate demand? Private sector behavior changes over time. Policy changes are implemented very quickly. Policy changes are implemented very quickly. No. In fact, if you remember, policy changes have problem with lag. They take time, implementation lag, and so on, right? Identification lag. See, if you remember, what are the different types of lag when it comes to policies? Recognition lag, action lag, impact lag. You see this? So policies are never implemented quickly. So that's a wrong statement. Fiscal policy focuses more on inflation than on unemployment. Uh, Fiscal policy is going to focus more on inflation. Fiscal policy basically focuses on increasing the biggest. What is the biggest objective of fiscal policy? Growth, correct? The biggest objective of fiscal policy is growth and redistribution of wealth. Compared to that, monetary policy's biggest objective is to keep the prices stable. Got it? Right? Next, when central bank announces a decrease in policy rate, it's monetary expansionary, right? The desired impact is an increase in what? Investments? Yes or no? When the rates are going to go down, investments will increase. No problem with that. Borrowing rates will actually go down. Currency's value will actually depreciate or appreciate. National currency's value in exchange of other currencies. See, when the government is going to reduce the rate, what happens to the currency? Currency rate increases. When you reduce the rate, what happens? Your borrowings will increase, isn't it? Your investments will increase, correct? So the rate, interbank borrowing rates won't go up. Clear? So what is going to be the immediate effect? The immediate effect is that the investments will increase. Clear? Which action of the central bank least likely to take if it wants to encourage business and household to borrow for investment and consumption? Means they want to make the economy expansionary. Which one is not expansionary? Okay. Sell long dated government bonds. First of all, this is OMO, right? Central bank's OMO operation. Buying and selling of bond is OMO. So when the central bank sells the bond to the banks, it will suck the money from the system. That's expansionary? No, that's contractionary. So this is wrong. They want to encourage. This cannot be done. Purchasing is expansionary. Purchase mortgage bonds, these both are expansionary. Understood? Everyone? Check, confirm. Okay. A central bank's repeated OMO purchase, central bank is buying bonds from the market. Is it expansionary or contractionary? First, tell me. Before I go ahead, central bank is buying the bonds from the market. Is it expand? Yes, it is expansionary, right? Because when you buy the bond, you flush with more money. Uh, Decreases money supply? No, it increases. Is prohibited in most countries? No, in fact, most of the countries use OMO. Is consistent with expansionary monetary policy. Understood, everyone? Clear? Buying bonds from the market is expansionary. Can I ask you something? What when the central banks buy the bonds at a massive scale, including private company bonds? What is that called as? That is called as QE, quantitative easing. Understood? QE. When the bond buying is done at a massive scale, like what US did in trillions of dollars, that's QE. Raising the reserve requirement, reserve ratio. When you increase the reserve ratio, the money that the banks keep with the central banks, that's contractionary. Is an example of which type of monetary policy? Neutral, expansionary, it's contractionary. Easy, correct? Next. Which of the following is a limitation on the ability of central bank to stimulate growth in periods of deflation? Guys, what is the situation in deflation? Normally, when a central bank wants to increase the economy, they will reduce the rates. But deflation is a situation where the interest rates are already near zero. So can the interest rates go below zero? No. In the history, it has happened once or twice with Swiss bank interest rate going negative, but it cannot sustain there. Interest rates cannot fall below zero, right? So what is the problem here? What is the limitation? The limitation is that the interest rates cannot fall below zero. That's the reality. Understood? Clear? That is where their hands are tied. Understood? Clear? Now we go to geopolitics and gradually to trade and currency. A consequence of one of the disadvantages of globalization. Why is people like Donald Trump doing deglobalization, right? What is the disadvantage? The biggest disadvantage is that many people lose job, and of course, it's going the opposite way of globalization. But that's the reality these days. Do you see the political fight is not for globalization, but it is for anti-globalization? Pay difference is that pay differences between countries have narrowed? No. Emerging market trade flows have grown. Okay. Great economic and financial cooperation has increased interdependence. A consequence of one of the disadvantage of the globalization is that, yes, anyone? I've got one answer. Very interesting. See, what happens because of globalization? You're very much dependent on the other nations now, right? So you are highly dependent on those nations. So the interdependence, economic and financial cooperation has increased interdependence. That can be said as one of the disadvantage. The A and B, they are not disadvantage. Pay differences being narrowed or emerging markets, business growing, those are not disadvantages. Those are advantages. But the interdependence on the nations, that is a problem. And you're so much dependent on them that sometimes they take a undue advantage of that. Imagine this is exactly what Donald Trump is saying, that y'all have taken undue advantage, Canada has taken undue advantage, Mexico has taken undue advantage. He's exactly saying the same thing. Understood? Right or wrong is, I leave it to y'all to judge. Which of these is most likely to be described as event risk? See, what is an event risk? Event risk is when you know the event, but you don't know the outcome. Earthquake, do you know when earthquake is going to happen? No, earthquake is an example of something beyond your control. It's an exogenous risk. Election is an event risk where you know the event, but you don't know the outcome. Ongoing civil war is an example of thematic risk, which is a continuous risk, right? Ongoing civil war in many of the African nations that you see is an example of thematic risk. Clear? Which type of, now we go to trade restriction, favorite topic of President of the United States, right? He was in one of my sessions. That's where he saw that, oh my God, this is really bad. Then after the session, he went and he saw, oh, India is putting tariff on imported cars of 300%. China is putting so many percentage in. When Chinese cars and Indian cars come to my country, there is no tariff. Let me go back. So one of my student who went rogue after the session is the president. So which type of trade restriction would most likely increase domestic government revenue? Exactly, this is the question that triggered him. Yes, this is a topic now I don't even have to teach. People have become expert about it. Which one is going to increase the government revenue? Tariff, isn't it? The most searched word in the recent history. Which of the following trade restriction is likely to result in greatest welfare loss for the importing country? For the countries which is going to import, see, in tariff and quota, at least the government makes some money. In tariff and quota, the government makes some money. Why? Because they collect the fees or the taxes. In tariff, they collect the taxes. In import quota, they collect the license fees. But in voluntary export restraint, there is no benefit at all. Voluntary export restraint. Do you remember my example in from the videos? Which country? Toyota. Example of Japan. Japan realized that before US puts tariff on me, let me stop selling cars to US. Understood? Have you watched my videos? Then you will see this example. In fact, see, I'm not exaggerating my lectures, but I'm just telling you, if you see, as soon as Donald Trump came to the power, one president who actually president or prime minister of Japan, he actually visited US, and in the press conference, when the press asked, in front of Trump, that what is your view about your the tariff that United States is going to increase on you. So Japan being very smart, the prime minister being very smart, he said, I'm unable to answer your question. You can go to the YouTube and watch this. He so smartly answered that even Donald Trump started laughing. So Japan is a very nice example of that before you put tariff on me, I will only stop selling you more cars. That's voluntary export restraint. That is the greatest welfare loss. Why? Because in that you don't make any money. In tariff and quota, at least you get something. There is a lot of economic theory that many people are saying that Donald Trump is, doing a wrong policy and all. But trust me, if the countries, if I'm saying, if the countries comply with his requirement, he's actually going to make $1 trillion, and that will reduce the US budget deficit. So trust me, contrary to what you see in the social media, this is my personal opinion. I'm not that expert. But if he turns out to be true, if the other countries succumb to the pressure, see, China won't, but other countries will succumb to the pressure of US. They will be squeezed. They will be ready to pay the tariff or make a deal. Understood? So it's of course it's very bullying, but that's how the deal is made. A large country like US, and this is my favorite question. You know why? Because I don't know why many economists say that US is doing a stupid thing. Actually, in CFA curriculum itself, it is mentioned that tariff is a bad thing. Yes. But when a large country like US does it, which is the biggest consumer in the world, it actually benefits them. So large country can benefit by imposing tariff. This is there in the syllabus. It's not only my opinion. Okay. Why is that the case? Why is that a large country can benefit? Because the large country will impact the global prices. Trust me, when US has put so heavy tariffs on these countries, they will not sell to US. But then the price of these goods have fallen because they are not going to sell in the best market. So they'll have to sell these goods in other markets at a lower rate. So when a large country puts up a tariff, actually it's a good thing. So when US is putting so much of tariff on China, the other countries can take an advantage of it. They can buy the Chinese product which was about to be sold to US at a much cheaper rate. So, this is the best time to actually buy Chinese goods. Got it? Clear? Very interesting, isn't it? Okay, let's see this. Which of the following factors best explains why regional trade agreements are more popular than large multilateral trade agreements? Regional, close by countries, trade agreements are more popular. Correct? Why? Because minimal displacement cost, trade divergence benefit members, quicker and easier policy coordination. Yes, what is the appropriate answer? Regional, minimal displacement cost. No. Actually, forget Asia. In Asia, there is a lot of problem. But you look at Europe and US and other parts, right? Regional trade agreements like between the European Union or between the Gulf nations, right? their corporations are much stronger. Why? Because the culture is the same, the policies are almost the same, the impact is the same. So they are quicker and easier. Policy coordination makes regional trade agreements more feasible. Understood? So policy coordination and easier, because see, you can't live without the neighbor. You like the neighbor or not. Economic wise, it's difficult most of the time. So they are quicker and easier because they are out of necessity. Understood? Clear? Even the dreaded enemies like India and Pakistan, they have to share the water. There are many things that are shared. So they are much quicker because of the necessity. Clear? Now we move to the currency. What will be the effect on direct exchange rate quote if the domestic currency appreciates? First of all, let me tell you what is a direct quote. Direct quote, what is a direct quote? Direct quote is the one where the foreign currency is the base currency. So see, normally how do we write quote? We write quote as price currency to the base currency. In the direct quote, the price currency is the domestic currency, correct? Slash the foreign currency. Okay. So foreign currency is the base currency. They are saying what will be the effect on direct exchange rate quote if the domestic currency appreciates. So if the domestic currency appreciates, that means the foreign currency will depreciate. So can I say in that case, the direct quote will also go down, isn't it? So direct quote will, yes, decrease. Remember, direct quote is the quote where the foreign currency is the base currency. Clear? This next question is one of my favorite. Okay. Over the past month, Swiss franc has depreciated against the British pound by 12%. 12% means, let's say from 100, it went to 88, I can say, right? From 100, when something falls by 12 percentage, it goes to 88. Imagine that. Which rate? The Swiss franc against the British pound. So this is the rate of Swiss franc to the British pound. So it's the rate of Swiss franc. So Swiss franc has depreciated by 12 percentage. Imagine from 100 to 88. How much has the pound appreciated? Remember, the depreciation percentage is not the same as appreciation percentage. So now they are asking for pound. So if I want to do for the pound, what will I do, guys? See here, the pound. So CHF slash the pound. Now I'm going to talk about the pound. So guys, the pound, if the CHF has gone from 100 to 88, can I not say that the pound has gone from 88 to 100? Clear? 88 to 100 is how much percentage? So 88 is your beginning value, 100 is your ending value. So how do you find this percentage? Like same your holding period return of cons, ending over beginning minus 1. So if you do 100 over 88 minus 1, it will be definitely greater than 12 percentage. It is going to be 13.64 percentage. So the answer here is that the pound has appreciated by more than 12 percentage. Very good. Those who answered it. Amazing. Clear? Next, cross currency. I highly expect cross currency to be there, right? Cross currency. Do you remember the cross currency technique that I did in the class? Always look at the quotes and check. What are you going to check? See here, there is a currency called ZAR and HKD. We don't know what that currency is. Ignore it. But you should know that HKD is in the base and ZAR is in the price. So you have to look out for where ZAR and HKD combine. ZAR and HKD combine in these two quotes. Okay, so basically, if you want to find ZAR slash HKD, remember HKD is in the base. So I will look, is HKD in the base? Yes. So if it's in the base, I don't need to inverse it. I will keep it as it is, 0.8422. ZAR is in the price, but in the second quote, ZAR is also in the base. It's not in the price. So I will have to inverse it. So when I inverse it, that means I will have to divide it by 0.9149. This is the technique that I use. Okay, you have to check individually whether it's in base or price. If not, inverse it. So now if you do 0.8422 divide by 0.9149, you will definitely get a right answer, 0.9205. Understood the technique, everyone? Check, check, check. Next, the Japanese yen AUD spot exchange rate is given to you 82.42. So guys, they've given you spot exchange rate as 82.42. How many decimal it is? 2 decimal. Okay. See, normally if you know pips, what is pips? Pips or points is the difference between forward and spot. Understood? Whatever is the difference between forward and spot, right? That is generally given in pips. If it is 4 decimal, if it's in 4 decimal or if it's in 2 decimal, it does make a big difference. I will tell you why. So first of all, I have the spot rate now. This is the spot rate of what? Spot rate of which currency? I will write the currency JPY/AUD. So it's the rate of AUD in terms of Japanese yen. Correct? This is a spot rate. Japanese yen interest rate is given. Australian dollar interest rate is given. Now, if the interest rates are quoted based on 360-day year, the 90-day forward points. Now, guys, forward points. For forward points, you need the difference between forward and spot. You have the spot, but you don't have forward. So this question that I've chosen is because that for finding the forward, you need to use the interest rate parity. What is interest rate parity? If you are aware about the interest rate parity, everyone in the class, interest rate parity is where you are going to find forward based on spot into 1 plus interest rate ratio of price currency to the base currency. Right? That is your interest rate parity. Now for finding forward, you have the spot rate that is 82.42. They've given in 2 decimal. So you'll also have to find in 2 decimal. Into now becomes an interesting thing for which I'll write it here to find the forward 82.42 into 1 plus interest rate of price and base. So I will write 1 plus interest rate of what is the price currency? Japan is the price currency. AUD is the base currency. So I need Japanese interest rate on the top, which is 0.15 percentage. Am I correct? Japanese interest rate is 0.15 percentage. So this is 0.15 percentage. And the Australian interest rate, which is the base currency, is 4.95 percentage. However, very, very important thing. These interest rates are always annualized, but they are asking you for a 90-day. So you need to do one more change is you need to convert the rates into 90 by 360. Everyone. First, you should be aware about this. Second, you should know how to solve this. So to solve this, there is a technique. First, you need to put the interest rate in your calculator, 0.15, press percentage, then press 90 divided by 360, and then press 1. Are you getting 1.004? I'll repeat. First, you press percentage into 90 by 360 equal to, then press 1. You should get 1.004. Store 1. Same way you do the denominator, 4.95, then percentage sign into 90 divided by 360 equal to plus 1. You will get 1.0124. So the denominator is 1.0124. Store 2. Now, again, if you press recall 1 into 82.42 divide by the denominator, that is recall 2. So divided by recall 2, you will get 81.44. Are you getting 81.44? Let me know. In this one example, there are 3-4 concepts included. Everyone, let me know if you're getting 81.44. Check. Everyone, yes. Okay. Now, guys, you have forward and you have spot. So the difference between both forward and spot, that is 81.44 minus 82.42. Of course, it's negative. Why? Because the value, the rate, it's a discount. The currency rate is going down, right? So how much is the difference? 81.44 in your calculator, 81.44, right? 81.44, whatever the answer you have. I suggest you to keep it exact. What was the exact answer, everyone? Exact answer in your calculator, if you keep the exact answer, it is 81.4430. I suggest you to store it. Store 81.4430, but you write here only two decimal. Minus 82.42. If you do, see this. You will get an answer of the difference, which is minus 0.9770. This is what your answer is, right? Now, but that's not the answer that you have there. It's either B. Of course, the closest is B. But my answer is 0.9770. How do I convert this into the normal in pips? See here, if the currency quote is in two decimal, that means two zeros after the dot, there are two decimal, right? So that means the pips are always in hundreds of units. They are always in 1 divided by 100. If the currency decimal is in 4, that means they are 1 divided by 10,000 points. So if my currency quotation was in 4 decimal, then I would have multiplied this with 10,000. But since the quotation is in 2 decimal, then I need to multiply this with 100 to get the exact point answer. This is where my answer will be minus 97.70. All these techniques I've discussed very well in my lectures. Otherwise, if you are not aware about it, you'll need to practice that. Now, this question is very important because it includes so many concepts. First, it includes interest rate parity, then the difference between spot and forward, and how to convert that into pips. Very tricky. Most of the questions that you see in your syllabus, they are in 4 decimals. So every time we did in 10,000s. This is the only question that I saw it's in 2 decimal. So that is where you multiply with 100. Also, this is one of the very few questions where the interest rate parity is also broken down into 90 days. Normally, they give you annualized only. So they put all the complexity that they can in this question. Got it? Everyone? Perfect. That's the end of your economics. Again, I will tell you where did we start. I told you something interesting about the topic. What is the interesting thing about the topic? That in economics, it is difficult to, I told you, it's easy when you read it, but it's difficult when it comes to scoring because the choices are so much, the difference among the choices is so less. Okay. And the choices are so confusing most of the time. So again, I repeat, economics is easy to read and understand, but difficult to score. So practice as much as you can. Got it? Perfect. By the way, I hope you are realizing that by practicing with me, y'all in this program, y'all are actually covering most of the CFA Institute's critical questions. Okay. Right. So sometimes students say, I will do it later and all. So this is where I suggest students to practice all these questions after the syllabus is done. Don't do this in between the syllabus. You'll get depressed. When your syllabus is done, when you are on the revision mode, that time you do all this practice. Correct, everyone? All right. Perfect. Okay. Thank you so much.